Uh, the topic we are discussing here is sensitivity analysis in advanced capital budgeting chapter, and the question we are solving here is question number 12 in ICA module study material. Okay, now see, first of all, sensitivity analysis is nothing but how much percentage of change in a particular parameter makes the NPV, sensitivity analysis is nothing but how much percentage change in a particular parameter will impact the NPV. Okay, that is what about sensitivity analysis. So in calculations of NPV, whatever the factors you are using or whatever the parameters we are using, in each particular parameter the percentage of changes will be considered to calculate the impact on the NPVs. Okay, now here the Easygoing Company Limited is considering a new project with initial investment for a product survival. Okay, it is estimated that IRR of the project is 16% and having an estimated life of the 5 years. Okay, the project period is 5 years and the cost and IRR of the project is 16%. Okay, financial manager has studied that project with sensitivity analysis and informed that annual fixed cost sensitivity is 7.8416. See here he is talking about a particular parameter, that is annual fixed cost, and its sensitivity is 7.8416. So in general, sensitivity analysis will be considered as will be analyzed as how much percentage change in annual fixed cost will adversely impact the NPV. Okay, that means the impact of NPV also calculated for a given percentage of change in fixed cost. But here, as he is considering sensitivity of 7.8416 with respect to annual fixed cost, it implies by changing of annual fixed cost with 7.8416%, the NPV becomes 0. Because there is no impact of NPV is given here, it will be considered as by changing of 7.8416% with in annual fixed cost, the NPV becomes 0. We have to consider like this. Okay. Similarly, another parameter is whereas cost of capital sensitivity is 60%. So if we change cost of capital by 60%, NPV becomes 0. Okay, and other information available or profit volume ratio is 70%, variable cost is 60 per unit, annual cash flow 57,500. Okay, here he is saying that ignore depreciation on initial investment and impact of the taxation also be ignored. So we have to calculate these 5 points and consider these annuity factors given in the question at a particular percentage of cost of capitals or discounting factors. Okay, this is what the question is about. Okay, now let's calculate initial investment of the project. So if you see, we are having two types of patterns in calculations of NPV. That is, in the case of unequal cash flows, it will be, the pattern is years and cash flows, unequal cash flows, and present value interest factors at cost of capitals, and we can calculate present value cash flows. It will be present value of cash inflows, and we have to deduct initial investment from this. We will get NPV. Another formula when we are having equal cash inflows is annual cash inflows into present value annuity factor at given percentage of cost of capital, and for the life of the project we will get the present value of cash inflows, and we will if you deduct the initial outflow, it will be NPV. Okay, these two types of patterns are there in calculations of NPV when you are having the annual unequal cash flows and equal cash flows. Okay, let's solve initial investment of the project. See, in the question it is mentioned that annual cash inflows are 57,500. See, now we have to consider this kind of equation formula for calculating NPV. Okay, so similarly, annual cash inflows into present value factor, IRR. Why we are using IRR? Because the question is having only one discount rate, that is IRR, and we know that at IRR NPV of the project is 0. So we can substitute the figures given in the question in this equation. We will be left with only this initial outflow. Thus we can calculate initial outflow. Okay, so if you substitute annual cash inflows with the information given in the question, it is 57,500 and IRR is 16% and life of the project is 5%, and initial outflow we don't know. NPV, we know that at IRR project NPV is 0. Okay, so thus NPV equals to 0. Now if we solve the equation, it will be given, we get initial outflow equals to 188,225, because present value annuity factor at 16% for 5 years. In the question, the table contains the value of 3.274. Accordingly, if we solve the equation, the initial outflow is 188,255. So the main point here to consider to calculate initial investment of the project is at IRR, NPV is 0. So now you are having annual cash inflows, present value annuity factor at 16%, that is IRR, and 5 years, and NPV is 0. The remaining factor only unknown is initial outflow. Thus we can calculate initial investment of the project. Okay, let's go to second point, that is net present value, NPV of the project. So in the question it is given that cost of capital sensitivity is 60%. That means change in cost of capital by 60% makes the NPV 0. So we know at IRR NPV is 0. That means if we carefully observe, if you say cost of capital is X, then the change in cost of capital with 60% means post changed cost of capital. So this total gives us post change in cost of capital. Let's say like that. Okay, so at this post COC the NPV is 0, and also at the 16% rate NPV is 0. So why can't we equate these two points? So accordingly, if you can solve this equation, we will get X equals to 10%. That will be cost of capital of the project is 10%. See, so accordingly we have annual cash inflows, and also discounting rate, and also life of the project, and also initial investment. The unknown factor here only is NPV. So if you substitute all the known values in this equation and solve, if we will get NPV equals to 29,727.5 rupees. Okay, see, the main key point here to calculate NPV in this question is it is given sensitivity 60%. So if we consider cost of capital be X, and consider the change in cost of capital to calculate a post change in cost of capital rate, that will be X plus 60% of X. That means 1.6x. So at this rate of cost of capital, NPV is getting 0, and also we know that at this 16% IRR rate NPV is getting 0. Thus we can make the equation and accordingly solve, we will get 10%. Okay, let's go to third point, that is annual fixed cost. So it is given that annual fixed cost sensitivity equals to 7.8416%. That means if we change annual fixed cost by 7.8416%, it makes NPV 0. So accordingly, we know this standard equation, that is annual cash inflows discounted at present value annuity factor. If we substitute this present value cash inflow with initial outflow, we will get NPV. So similarly, if we substitute the same equation with the given figures, we can solve the question of annual fixed cost. That is, here we know annuals, that is a change in annual fixed cost. If you have to substitute annual cash inflows with change in annual fixed cost, and present value annuity factor with present value annuity factor, cost of capital and life of the project. See, here we are comparing the present value of change in annual fixed cost with NPV to make 0, because by change in annual fixed cost with 7.8416%, it makes the NPV 0. So thus here NPV value substituted with 0, and annual cash inflow substituted with change in annual fixed cost, and present value percentage with will be the same as per cost of capital and life. And initial outflow, here we are comparing annual fixed cost change and NPV. Thus here initial outflow will be replaced with NPV. Thus this equation is framed. Okay, let change in annual fixed cost be X, and accordingly we know all the values except NPV, because here we are substituting change in annual fixed cost with X, and also the present value annuity factor with this formula, and NPV equals to 0. Accordingly, if we solve the equation, we will get X equals to 7,841.6 rupees. Okay, thus change in annual fixed cost is 7,841.6 rupees. So here we know the change in percentage as well as in amount terms. So the only unknown factor is fixed cost. So let's say annual fixed cost is Y, and if you consider the change percentage with respect to y, that is annual fixed cost, it will be equals to 7,841.6. Accordingly, if we solve the equation, the annual fixed cost we get is 1 lakh rupees. So the main key point here to know to calculate annual fixed cost is change in annual fixed cost occurring in the, change in fixed cost is occurring in annual terms. Okay, that's why we have to consider the change in annual fixed cost with annuity factor. Okay, and as we are if you consider this only part which is in brackets, it will give the present value of change in annual fixed cost, and we are comparing this present value of change in annual fixed cost with NPV. That will be 0. So thus framing of this equation is done. The key point in this part is this. Okay, let's go to fourth point, that is calculation of estimated annual units of sales. Okay, we know this pattern, right? We know this format. Sales minus variable cost, we will get contribution. We will, after deducting fixed cost from contribution, we will get EBIT, that will be annual cash inflows, and minus interest, it will be EBT, tax, EAT, PAT. Okay, we know this format. And formula for PV ratio equals to contribution by sales, and if we deduct 1 minus PV ratio, it will be VC ratio, that is variable cost ratio. That is variable cost ratio means variable cost divided by sales into 100. These are all the points useful for calculating estimated annual units of sales. Okay, in the question it is given that PV ratio is 70%. So that means using this formula we can calculate VC ratio, that is 30%. We know VC ratio is 30%. We have VC, we have sales, we have variable cost in the question, that is 60 rupees. So if you replace values with values in this equation, that will be give us sales value of 200 rupees per share, per unit. Okay, it is per unit terms, not in. Okay, so it means the cost, sales price per unit is 200 rupees. Okay, let's the quantity of sales be X. Why you're using is we need to calculate annual units of sales, right? So first of all, we know this formula. In this format, if you convert into equation format, then it is nothing but sales minus variable cost, and it will be giving a contribution per unit. And if you multiply this per unit contribution with the quantity, that will be total contribution. Means this step, after minusing the variable fixed cost from the total contribution, it will give us a EBIT. Okay, so accordingly, we don't know the quantity here, we know the fixed cost, we know the EBIT, we know sales, we know variable cost. So let's quantity be X. Okay, then accordingly, if we solve the equation by substituting all the known values in this equation, it will be 140x equals to 157,500 rupees, 157,500. So that will be giving us x equals to 1125 units. That is, number of units of sales is 1125 units. So the main key point here is given PV ratio, calculate VC ratio. Accordingly, we know the sales per unit cost, per unit price of sales, and using this format, or you have to frame this equation, and all the known values are here we know, and except only quantity we don't know. So let it be X, and accordingly, if you solve the equation, we will get a number of units of sales, that is 1125. Okay, now the only remaining part is calculation of break-even units. See, break-even is nothing but cost equals to sales value, or inflow. Simply, cash inflows equals to cash outflows. So that is, we know in the previous format this equation. Here EBIT, in the previous equation we instead of 0 we have EBIT, but now as we are talking about break even, we have to substitute that EBIT value with 0 in the same equation. Now we know the sales value, we know the variable cost, we don't know the quantity of break even units, let it be X, and we know the fixed cost. And accordingly, if you solve the equation, it will be X equals to 714.285 units. Means at this number of units, if we sell these number of units at 200 rupees sales price with 60 rupees cost and fixed cost having 1 lakh rupees, then we don't have any profit or any loss. Okay, that's it. This is all about question number 12 in advanced capital budgeting, that is with respect